All right, welcome back. You're tuned into Market Fatafat, where we are taking you through all the stocks that are buzzing away in trade. And now on the technicals, we're joined by Nagaraj Shetti, Technical and Derivative Research Analyst, HDFC Securities, and Junai is, of course, joined again from our research team. But let's get started. Let's resume with all the stocks that are in focus today. Nagaraj, you've picked out First Source Solutions for us. Tell us, what do you see as the charts for this one? I mean, this one in the last, it's soaring away in trade. It's up 12% right now. In fact, in the last 6 months, also some stellar gains coming in on this counter. Do you see more upside to this?
Yes, good afternoon. FSL has been in a sharp uptrend in the last few months, and recently we have seen consolidation moment. And in this week, market has this particular stock has bounced back above the hurdle of the consolidation pattern around 325, 330 levels, and currently trading higher. The overall chart pattern is indicating a upside breakout of bullish flag pattern, and I'm expecting more upside to come for the stock price in the near term. The next resistance to be watched for the stock is around 385.
All right, 385 levels are what we're watching out for First Source. But coming to you, Junai, Paytm reported its earnings yesterday. In fact, a couple of brokerage notes that have come out and a news flow also tell us what is it all about.
Well, definitely Paytm is in focus. First, let's talk about the news flow. So, the Paytm has finally received approval from NPCI to onboard its new clients for the UPI users. Also, we have on back of this, we also have a couple of brokerages note. First, we have UBS who are maintaining a neutral rating with the target price of 490. Now, they say that the grant approval is a positive and would allow Paytm to gain its grow customer base again, as well as gain in payments GMV. We also note by Bernstein who are maintaining outperformance rating with a target price of 600. Now what they believe is first this regulatory catalyst rolls in, and this could actually mark a bottom in the MTUs as the new users can now be onboarded. Also, this should come as a welcome relief for the company, and Paytm definitely focus on back of this.
All right, moving on now, and we are joined by the management of NIIT Learning right now. Sapnesh Lala, CEO, NIIT Learning System, is joining us. Hi, Mr. Lala. Thank you so much for joining us.
Thank you.
Mr. Lala, tell us, the overall margins have reduced by 10% to 47%. What has led to this degrowth in the margins?
Well, the margins have actually not degrown by 10%. The margins are robust at 24%. EBITDA margin is at 24%. The revenue has grown 4% year on year. The PAT is up 22% year on year. So the margins continue to be robust and have grown reasonably.
Right. I beg your pardon, Mr. Lala. Also, tell us, the company has added 2 new MTS customers, and any more any bigger client additions, expected over the next 2 to 3 quarters. And which sectors are the client requests really coming from?
So we've added 2 new customers, like you pointed out, one FMCG top 10, as well as one energy top 10 market leaders in their industry segments. We see growth in BFSI. We have a number of opportunities in BFSI. We have seen a quarter-on-quarter recovery on tech. We onboarded a large customer who's a tech major just a quarter ago, and we are starting to see ramp up from a tech perspective. So we see the recovery in tech. We see robust growth in BFSI as well as life sciences.
Also, Mr. Lala, company has been stating that a strategic focus on innovative solutions, including the Gen AI platforms, have been a key drivers for the company and for customer addition and retention. So, what kind of incremental growth and contribution to top line is expected from these segments? Give us a color on that as well.
So, our customers are continuing to trust us with more and more work. They are looking at how we are innovating. They are embedding the fact that we are among the best in innovation across the industry as they make choices for long-term relationships with us. So from an overall perspective, our customers feel that we have the pole position on use of AI in learning, while our customers have not started using AI in learning at enterprise scale, but the fact that we have solutions available gives them confidence that as their organizations start becoming more open to use of AI at an enterprise scale, they will have a partner who will be able to enable them to get those benefits. They are starting to use AI at departmental level on small proof of concepts. We have done a number of them, but slowly the customers are starting to warm up to use AI at enterprise scale.
Lala, any new product launches or any tie-ups on the annual for company?
We have a number of innovative products that we work with for our customers, but most of what we do is custom built for our customers. So we meet the customers where they are and custom build our solutions around their specific needs.
Also, how about the headcount trend? What does that look like for the next 2 to 3 quarters? Any softness coming in any of the sectors?
For us, the headcount has, from a year-on-year perspective, gone down a little bit because we've seen some productivity gains by deploying some of the innovative technologies that we have built. Over time, we think that we will increase headcount. Across our customers, we are not seeing excessive increases in headcount. In fact, with some of our professional services customers, we actually saw a decline in their headcount.
Also, finally, Mr. Lala, are you seeing more outsourcing opportunities as demand from developed markets have improved, and also India has become a key place for global delivery centers?
Yes, we are seeing increased outsourcing demand as the uncertainty persists and there is pressure on cost, as well as there is a desire to innovate. We are at that interesting intersection where there are a number of organizations who are looking at restructuring, and that restructuring is being caused by an effort to drive down costs, increase variability, as well as a desire to transform using new innovative technologies. So we are at that cross section, and I think we are very well positioned to take benefit from being at the position where we are in terms of acquiring new customers, retaining our existing customers, as well as expanding what we do with our existing customers.
All right, Mr. Lala, thank you so much for taking the time out and joining us on ET Now. On that note, we will let you go. But we will resume with all the stocks that are in focus today. Coming back to you, Jinai, ICICI Prudential is the name that you picked out for us. An earnings candidate, tell us what does the report card look like?
Well, definitely. If you look at the net premium income, it came at 10,754 crores versus 10,022 crores, so improving about 7.3% year-on-year basis. Also talking about PAT, it improved about 3%, coming in at 251 crores versus 244 crores year-on-year basis. Now, if you look at AEP, it grew about 26.8% year-on-year basis to 4,467 crores in first half of FY25 versus 3,523. in second half of FY24, so on year-on-year basis. Also, company's total AUM grew by 18% year-on-year basis to 3,20,000 crores. We also have note by JM Financial, who have maintained buy rating with a target price of 880. Now, what they believe that the company posted a strong growth with consistent margins. Also, the growth was led by ULIPs and the company's focused products and annuity protection. They believe that the channel growth was broad-based, and they are expecting a 30% plus individual APE growth until Q3 of FY25.
All right, that is ICICI Prudential on the back of results. But coming on to another earnings candidate, a nifty candidate that is due for its earning today. That's HUL. Let's look at what the street is penciling in. In fact, the stock is absolutely flat. It's trading in the red right now, flattish for now. But on a quarter to FY25 standalone basis, we are expecting a revenue uptick of 3.4% on a year-on-year basis. The EBITDA is likely to be seen at 3,730 crores versus 3,694 crores, up 1%. PAT we're expecting to cool down at 2.2% on a year-on-year basis, and the EBITDA margin is likely to come in at 23.8% versus 24.6% on a year-on-year basis. Now, the key expectations are that the volume growth is expected to be at 5%. The health food drink segment is likely to continue to remain weak. The home care segment is likely to grow 5.3% on a year-on-year basis. The food and refreshments segment is also likely to grow at 4.5% on a year-on-year basis. We expect a 35% year-on-year decline in other operating income due to the discontinuation of GSK OTC distribution business in November 2023, and the EBITDA margin is likely to compress due to the one-off items and lower operating income and higher ad spends and commodity inflation and increase in the royalty fee. So that's what we're expecting from HUL. But keeping with the FMCG space, we also had Gautam Shah, who believes that it is safe to play the consumption theme with big names such as ITC and HUL. Let's go across and hear out his take on that sector.
You have to really play consumption and FMCG as a theme. Again, I want to go with the big boys. I don't want to go lower down. I'm still very, very comfortable with ITC and HUL. I think at 470, 480, there is just not much to lose in ITC. And again, I'm quite confident that over the next 1 year, you will see an ITC move gradually towards a level of 600. And HUL also presents an opportunity after the correction of the last 1 month. But if you look at the other names, the Maricos and the Daburs and the Godrej consumers of the world, I don't get that confidence to make serious commitment. So stick to the top 2 names and I think you should be okay.
All right, moving on then to another counter that is in focus today, RITES Limited. That stock has surged nearly 3% today. After the company secured a major contract worth 454 crore rupees from the Karnataka Mining Environment Restoration Corporation. The execution period for this is going to be 30 months from the date of signing the agreement or date of site handover, whichever is later. And on the back of this big order win, RITES India is in focus today. But moving on then, we will move on to the next counter that is going to be in focus today, and that is Asian Paints, another earnings candidate which is going to report its numbers, and we are expecting it to come out anytime soon. But let's look at what we are expecting from Asian Paints. Right now, currently the stock is trading absolutely flat. The revenue is, we're seeing an uptick of 1.6% on a year-on-year basis. We are also expecting a PAT decline of 7.7%, and the EBITDA margins are also likely to see a decline of 8.7% on a year-on-year basis. We expect 5 to 6% volume growth. The profitability is likely to be impacted due to higher promotional activities, and the margins will be affected by the unfavorable base and a rising monomer costs despite the minor price hikes by the paints company and the weak demand trends across the paints and adhesive in Q2 as erratic monsoons weigh on the paint demand, and that is likely to weigh in on the margins also. Like I mentioned, couple of factors to watch out for are going to be the demand outlook, the competitive landscape, and of course the gross margin trends for Asian Paints. So that is likely to report its number anytime soon now. But currently the stock is trading absolutely flat with minor gains of 0.3%. But with that, it's time for us to step into a short break. Don't go anywhere, we'll be right back.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.